Welcome back to Boni's Life. I'm Boni, and this is your crypto weekly analysis for the week of Monday, July 7th to Saturday, July 12th, 2026. If you've been watching the charts this week, you know exactly what kind of roller coaster we've been on. We went from a quiet recovery on Monday to a sudden geopolitical shock on Wednesday, and then a massive institutional inflow reversal by Friday. It's been a week of extreme cross-currents, where macroeconomic data, military strikes, and ETF flows all collided. Today we are going to break down exactly what moved the markets, why the assets reacted the way they did, and most importantly, what you need to prepare for in the upcoming week. Because next week, with the US CPI data dropping, is going to be a make or break moment for the entire crypto market. Let's get into it. Let's start by looking at the week in review day by day. Monday, July 7th, opened with a sense of cautious optimism. Bitcoin was trading around $63,340, holding steady after recovering from the brutal lows we saw at the end of June. The market was trying to find its footing. We saw spot Bitcoin ETFs record a modest net inflow of $21.5 million, with BlackRock's IBIT contributing $54.8 million of that. Ethereum was hovering right around the $1,800 mark. The sentiment was shifting from extreme fear back to neutral. It felt like the market was finally exhaling after a suffocating June. But as we know in crypto, quiet Mondays are often just the calm before the storm. Tuesday, July 8th, is when the geopolitical reality shattered that calm. President Donald Trump announced that the fragile ceasefire between the United States and Iran was officially over. Almost immediately, the US military launched strikes against Iranian targets. Reaction across global markets was instantaneous. WTI crude oil futures jumped over 2% to $72.27 a barrel. The US dollar index held firm above 101.00. And Bitcoin? It did exactly what risk assets do during a geopolitical shock. It sold off. Bitcoin slipped nearly 1% to $62,657. We also saw $84.86 million flow out of the Bitcoin ETFs. This is a crucial point to understand. In moments of sudden military escalation, Bitcoin still trades as a risk-on asset, not a safe haven. When the bombs drop, capital flees to the dollar and to oil, and it drains out of crypto. Wednesday, July 9th, saw the escalation intensify. The US and Iran traded strikes over the strategic Strait of Hormuz, a choke point that handles roughly a fifth of global oil trade. The US Central Command confirmed strikes on over 80 targets in Iran. VIX, the stock market's fear gauge, spiked nearly 5% to 16.90. The S&P 500 closed in the red. Bitcoin took a harder hit here, falling over 2% to $61,688. Ethereum dropped 1.64% to around $1,750. The ETF outflows continued with another $95.30 million leaving the funds. Market was pricing in the risk of a broader Middle East conflict and the inflationary shock that a disrupted oil supply would cause. If oil goes up, inflation goes up. If inflation goes up, the Federal Reserve keeps interest rates high, and high interest rates are the enemy of Bitcoin. But then came Thursday, July 10th, and the narrative flipped again. Despite the ongoing geopolitical tension, the structural demand for Bitcoin reasserted itself. Bitcoin recovered back above $62,600 and pushed towards $64,295. Why? Because the institutional buyers stepped back in. We saw a massive $90.4 million net inflow into the US spot Bitcoin ETFs, completely reversing the two-day outflow trend. BlackRock's IBIT alone pulled in $86.8 million. This wasn't retail traders buying the dip. This was coordinated institutional capital, deciding that the mid-$61,000 level was a prime accumulation zone, regardless of the headlines coming out of the Middle East. Ethereum also bounced back, climbing $56 to reach $1,796. Friday, July 11th, confirmed the recovery. Bitcoin held strong at a critical crossroads around $64,184. This represented an 11% recovery from the July 1st low of $57,748. The market was testing the $65,500 resistance level. What's fascinating here is the underlying mechanics of this bounce. Earlier in the week, as Bitcoin broke above $62,000, it triggered a massive short squeeze. Over $450 million in leveraged short positions were liquidated. When you short Bitcoin and the price goes up, you are forced to buy Bitcoin to cover your position, which drives the price up even further. It's a chain reaction of forced buying. The bears got trapped and the bulls capitalized on it. And that brings us to today, Saturday, July 12th. As I record this, Bitcoin is trading at $63,971, down just slightly by 0.38% on the day. Ethereum is sitting at $1,803, up 0.20%. Over the past 24 hours, we've seen $279 million in crypto futures liquidations. Volatility is still very much alive, but when we zoom out and look at the week as a whole, the resilience is undeniable. Despite the end of the US-Iran ceasefire, despite multiple rounds of military strikes, Bitcoin managed to post a net weekly gain of roughly 1.3%. Let's put this into perspective with a real-world simulation. If you had invested exactly $100 in a spot Bitcoin position at the Monday open of $63,340, here is how your week would have played out. By Wednesday, during the depths of the geopolitical panic when Bitcoin hit $61,688, your portfolio would have dropped to $97.39, a loss of $2.61. But if you held your nerve through the fair, by Friday's close at $64,206, your portfolio would have rebounded to $101.37. Today, on Saturday, you'd be sitting at $101. 1% gain might not sound like much, but in a week where bombs were dropping and oil was surging, preserving capital and grinding out a positive return is a massive victory for the asset class. If you had put that same $100 into Ethereum at $1,800 on Monday, you'd have dipped to $97.22 on Wednesday, and you'd be sitting at $100.22 today. The biggest structural takeaway from this week is the ETF flow data. For the week ending July 10th, US spot Bitcoin ETFs pulled in $197.4 million in net inflows, and Ethereum funds added $84.42 million. This is monumental. It marks the first positive week of inflows since May, ending 8 straight weeks of brutal net outflows that had drained billions from the market. The bleeding has stopped. And it's not just that the bleeding stopped, it's who is applying the bandage. On July 6th, BlackRock's IBIT absorbed $209.4 million in a single day, 79% of the total inflows. When BlackRock leads, it signals deep institutional conviction. They are building long-term positions. We also saw some massive developments beneath the surface this week. Circle, the issuer of the USDC stablecoin, secured a federal trust charter. This is structurally incredibly bullish. It integrates stablecoins deeper into the traditional US financial system. Meanwhile, the Intercontinental Exchange, the parent company of the New York Stock Exchange, announced a joint venture with OKX to build tokenization infrastructure. The NYSE is actively building the plumbing for the next crypto bull market. And on the supply side, on-chain data shows that the intense whale selling we saw throughout June is finally cooling off. The heavy distribution phase appears to be ending. But we cannot afford to be complacent, because the upcoming week, the week of July 14th, is an absolute minefield of macroeconomic events. This is where the rubber meets the road. On Tuesday, July 14th at 8:30 a.m. Eastern Time, the US Bureau of Labor Statistics will release the Consumer Price Index, or CPI, for June. This is the single most important data point. It stands between the market and the Federal Reserve's next interest rate decision on July 28th. Let's break down the CPI expectations. In May, headline inflation stunned the market by jumping to 4.2% year over year, the highest in 3 years. But that spike was almost entirely driven by energy prices, with gasoline jumping 7% in a single month. For June, the Cleveland Fed's nowcast model predicts headline inflation will cool to roughly 3.9%, while core inflation, which strips out volatile food and energy, is expected to remain sticky at around 2.9%. Because oil prices dropped roughly 20% in June, we should see the headline number come down mechanically. But the Fed doesn't care about the headline, they care about the core. If core inflation stays sticky, the Fed stays hawkish. Also on Tuesday, July 14th, the new Federal Reserve Chair Kevin Warsh will deliver his first congressional testimony. Lawmakers are going to grill him on the energy shock, the AI boom, and his approach to interest rates. Every word he says will be passed by algorithmic trading bots. If he sounds dovish, risk assets will fly. If he sounds hawkish, we will see an immediate sell-off. We are also entering the second quarter corporate earnings season, with major banks like JP Morgan and Goldman Sachs reporting. In an environment of high interest rates, companies are judged strictly on actual profits. If corporate earnings show weakness, it could drag the broader stock market lower, and crypto will likely get pulled down with it due to their ongoing correlation. And hanging over all of this is the geopolitical threat. The US has launched a third round of strikes, and Iran has threatened to close the Strait of Hormuz. If that strait closes, oil goes to $100 a barrel overnight, inflation expectations skyrocket, and the Fed is forced to hike rates. That is the ultimate black swan scenario for next week. So, how do we trade this? What are the probabilities and the technical triggers? For the next 24 to 48 hours, we are looking at 3 distinct scenarios based on the upcoming CPI data and geopolitical developments. Scenario 1 is the bullish breakout, and I assign this a 35% probability. This happens if the CPI headline comes in cooler than expected, say 3.8% or lower, and core inflation drops below 2.8%. This would signal to the market that the inflation threat is fading. The technical trigger here is a clean high-volume break and daily close above the $65,500 resistance level. Next liquidity zone is between $67,000 and $68,500. The optimal trading strategy here is to buy the confirmed breakout above $65,500 using the $64,000 level as your stop loss to protect against a fake out. Scenario 2 is the range-bound chop, which carries the highest probability at 45%. This occurs if the CPI comes in exactly as expected. The market gets no clear directional signal. Remain trapped between the competing forces of institutional ETF buying and geopolitical fear. The technical boundaries for this range are $61,500 on the downside and $65,500 on the upside. The strategy here is mean reversion trading. You buy near the $61,500 support and take profits near the $65,500 resistance. You do not use high leverage in this environment because the sudden headline risk from the Middle East will wipe you out. Scenario 3 is the bearish breakdown with a 20% probability. This is the nightmare scenario. It happens if CPI comes in hot, headline above 4.2% and core re-accelerating, or if Iran actually follows through on closing the Strait of Hormuz. A hot inflation print puts a July rate hike firmly back on the table. The technical trigger for this scenario is a loss of the $61,000 support level. If we break below $61,000, the trapdoor opens and we are looking at a rapid descent to test the recent lows at $57,700. The strategy here is capital preservation. If you are holding spot, you hedge. If you are trading, you look for short entries on any weak bounces, with strict stop losses just above $62,000. The overarching theme right now is tactical caution. The recovery this week was impressive, and the return of positive ETF flows is the most bullish structural signal we've had in 2 months. But the macroeconomic environment is a powder keg. We have a data-dependent Federal Reserve, a major inflation print dropping in 48 hours, and an active military conflict in the world's most important energy corridor. This is not the time to go all in with 50 times leverage. This is the time to be surgical, to manage your risk, and to let the data dictate your positioning. If you want to survive and thrive in this market, you have to look past the daily noise and understand the mechanics driving the price. When BlackRock buys $200 million in a day, that's a signal. When the VIX spikes to 17 on airstrikes, that's a signal. When the NYSE builds tokenization infrastructure during a bear market, that's a signal. The institutions are positioning themselves for the next decade of digital finance. The question is, are you? Thank you for tuning in to Boni's Life. If you found this deep dive valuable, hit that subscribe button, drop a comment below with your CPI prediction for Tuesday, and share this video with anyone who needs to understand what's really happening in the crypto markets. I'll be back next week to break down the CPI fallout and the Fed's next move. Stay disciplined, manage your risk, and I'll see you at the top. Peace.